Good afternoon, everybody. My name is Bob Hennessey, and I am with ARCA Capital, and I'm on the investor relations team here. And ARCA, we're a digital asset management firm with offices in Los Angeles and New York City. You could go to our website, we're www.ar.ca, and you'll find our blog on there, and you could register if you like. First of all, I want to thank everyone on here for your time. We all know how valuable, that is, and we want to make sure that we respect it. So again, thank you very much. So before I introduce the speakers, I want to go through the lineup. I have to make the statement, the disclaimer. So nothing stated in this presentation should be taken as investment advice, which would require a thorough assessment of each investor's personal and financial profile and risk tolerance. Statements regarding past performance are not necessarily indicative of future returns. So again, thank you for listening to that. I've been in the investments business for many years. I've marketed and seen just about every type of asset class, style, structure, you name it. And I can say without, in all of my years, I have not seen an asset class like digital assets. I mean, the explosive growth that's going on in digital assets right now is that's going on and will go on for the next 5 to 10 years will, in my opinion, dramatically change the way businesses are financed and, forever alter in a good way, how individuals will live their daily lives. Everything from the banking industry to the travel industry will be affected by the digitization of money and value. I mean, money is essentially becoming programmable, and it will ultimately unlock, lots of value out there, again, for investors and business owners. Bitcoin is clearly a big part of the story. And it gets a lot of the headlines for sure and will for many years, but there is a whole other part of the digital asset universe beyond Bitcoin where there are, endless opportunities for entrepreneurs and investors. So there are thousands of other tokens and coins out there in existence now. And there are thousands more coming. These are businesses, that use tokens to finance operations. So what is happening today in our world, in the investment allocator advisory space? Well, advisors and allocators are now starting to look into the asset class for their clients. And this is the main reason why my colleagues and I got together to create this educational roundtable. In this short hour, our goal is really for everyone that attends this roundtable is for you all to walk away with a better understanding of the asset class and the types of investments in the space, beyond Bitcoin. Of course, we'll talk a lot about Bitcoin, but again, it comes back to, the universe that's outside of Bitcoin, which is, again, a tremendous opportunity. So today's lineup is as follows. Our first speaker is Adam Blumberg. He is with Interaccess. Interaccess is an educational and research platform for advisors that want to learn more about digital assets. He is our professor of sorts, for today's lineup. He is going to provide a little talk on digital assets, and he's going to have a little whiteboard, and we're looking forward to his talk. Adam will then pass the comm over to Jeremy Boynton. Jeremy is with Pure Crypto. Pure Crypto is a fund of hedge funds. The underlying funds in his fund of funds are diversified amongst, different types of digital asset strategies. And he will go into how he selects managers and, where he sees opportunities today. And, Jeremy's also a wealth manager in RIA, so he has, he has a lot in common with many of the folks on this roundtable today. And then our last speaker will be my colleague here at ARCA, and his name is Jeff Dorman. Jeff is one of the founders of ARCA and is Chief Investment Officer for our digital asset fund. Some of you might know Jeff because he provides a lot of digital asset content on the internet. He publishes a weekly blog called The Two Satoshis and writes, several articles for websites like CoinDesk. Jeff is going to dig deeper into the opportunities within the digital assets universe. And, he's active on Twitter and LinkedIn. So if you want to follow him, just look him up, Jeff Dorman, and you'll find, you'll start getting his, weekly notifications of his blogs. And then finally, the last part of our presentation today will be a Q&A, and Zach Lindquist from Pure Crypto will host that. And there's a questions tab at the bottom of your screen there. So feel free to submit any questions. We'll try to get to all of them. And my email is bob@ar.ca. And should you all have any questions afterwards, feel free to reach out to me, and I'm gonna pop back in at the end of the presentation after everyone's spoken, and then I'll again give you my contact information. So again, thank you very much for coming today. I hope you get a lot out of it. And I'm going to pass it over to Adam. So take it over, Adam.
All right, thanks so much, Bob. So my name's Adam Blumberg. I'm with Interaxis. I'm also a certified financial planner, have an RIA in Texas. But we started Interaxis as a way to educate people about cryptocurrency, blockchain, digital assets, decentralized finance, and are spinning out a course for financial advisors, for RIAs, family offices, to learn about digital assets, how they can invest in them, how they can keep it safe, compliant, scalable, profitable. What I'm going to talk about today is a little bit about Bitcoin and then other digital assets. And I'm going to go on the assumption that most of the people that are watching this right now are not all that versed in Bitcoin and not all that versed in cryptocurrency. And so if you're thinking about allocating, on behalf of your clients or on behalf of your own fund, I want to talk a little bit about what you're allocating to, and just go into about 10 minutes about first Bitcoin and then some of the other digital assets that Jeremy and Jeff can get into. But a little bit of education hopefully goes a long way. So we're going to start with the granddaddy, the Mac Daddy, the first one of them all, and that's Bitcoin. So a little bit about how Bitcoin started. Bitcoin came into existence end of 2008, beginning of 2009, because people decided that in order for me to move money, in order for me to send money or have money, move it around the world, there were too many fees and too much friction, too many intermediaries. What do I mean by that? I mean, I'm over here, Bob is over here. Now, Bob could be in the next room, the next state, in some other country halfway around the world. If I'm going to send money to Bob, I have to send it over these rails, and these rails are owned and controlled by the banks. The banks decide how much they're going to charge, and the banks decide when I can do this, how long it will take, if they're even going to allow me to do this. So this is one intermediary that causes fees and causes friction. Now, I wrote this $ here because I'm assuming US dollars. This is controlled by the US government, right? They control how many of these there are, and therefore essentially the value of this. Again, more friction here and more outsourcing of our trust to some other entity. So the founders of Bitcoin, the founder or founders of Bitcoin decided this was not a solution we wanted anymore. We're a world that is more connected than this. We should be able to send money, store value, exchange dollars or exchange funds around the world more easily, and not be beholden to these banks that cause these fees and friction, not be beholden to the US government or other governments to determine how much money they're going to create and therefore the value. So what did they do? They had to create a system that is somewhat what's called decentralized. This is centralization. This is centralization. We're centralizing trust, creation, value, movement in these entities. So the founders of Bitcoin said, we don't like this centralization. They control too much. They have too much power. What are we going to do about it? Well, we created something called Bitcoin. And the idea is I need to be able to send funds to Bob without having to ask my bank for permission, without having to ask the government how much that money is actually worth, without Bob having to ask his government, whatever government that might be, what that money is worth at that particular time. So we have to have a way to send that money. And if we're going to do that without relying on these bank pipelines right here, then we have to do it in a way that's what's called decentralized. What does decentralized mean? That means we have all these, we'll call them nodes. They're miners, which are not exactly interchangeable, but we're not going to get into the technical part of that. But all these everywhere around the world that are interconnected via the Bitcoin code. And they all connect to this code worldwide. And what they do essentially is they process transactions. When I send Bitcoin to Bob, all these miners, all these nodes all over the world connected to this code are trying to help me process that transaction, get my 1 Bitcoin from myself over to Bob. They all compete for this transaction. So again, the founders of Bitcoin said, we want this decentralized nature here. We don't want to rely on banks. So we're going to rely on this code and all these computers connecting to it to process these transactions. Well, number one, why on earth would all these people connect their computers and take their processing power and their time and their money and their electricity to help process these transactions, to help move the Bitcoin from Adam to Bob? We have to give them some sort of incentive. And incentives are one of the keys that we see here in cryptocurrency and digital assets. How are we going to do this? Why are people going to connect? We have to give them the incentive. In this case, the brilliance of this system was the incentive is actually Bitcoin. The incentive for helping to process the transactions that are Bitcoin is actually Bitcoin. This is really genius. But when you think about it, the people who first started doing this had to have a whole lot of faith that those Bitcoins that they were mining, they were creating, were going to be worth something. And it just so happens that that's how it has turned out. So you have this decentralized system. And the decentralized system is set up to the point that if these nodes, if these miners go offline for any reason, these can all just pick up right where they left off. The code, the blockchain, as we call it, continues to move forward, okay? And they keep processing transactions. And every time they process a batch of transactions known as a block, there is a reward. And that reward, for whichever node processes that transaction, is in the form of Bitcoin. So Bitcoin is the incentive to get these computers, these miners, these nodes, these people that own these, to continue to process the transactions. Now, the beauty of Bitcoin is that there will only ever be 21 million of them. 21 million Bitcoin will ever be created. We're just over 18 million at the moment. And every 4 years, the amount of Bitcoin that's being created at every block gets cut in half. So it's the code is created in a way that the amount of new Bitcoin being created is always going down every 4 years. So these miners, these nodes, which originally people could do using a personal computer, now takes millions and hundreds of millions and billions of dollars invested in mining. These nodes are competing to process transactions so that they win Bitcoin as a reward. Now, there will only ever be 21 million. So an investment in Bitcoin, if you are looking to allocate on behalf of your clients or your own fund or your family or what have you, the investment in Bitcoin is essentially a macro investment. And Jeremy and Jeff can potentially talk about this, and that's probably what they would talk to you about if you're going them to allocate your money. This is essentially a macro investment. This is what people like Paul Tudor Jones and Bill Miller and Stanley Druckenmiller have looked at to say, and Michael Saylor of MicroStrategy, how he invested his corporate treasury. If the amount of dollars in the world are going up because we keep printing money, we're going to print more tomorrow probably, and next week and next week and next week. The amount of dollars are going up, the amount of Bitcoin stays at the same amount. What do we think happens to the price or the value of Bitcoin? It should generally go up, and that's the macro argument. So that's a little bit about how Bitcoin fits in. Now, keep in mind, there are several other cryptocurrencies that are built like this. Some of them are what we call forks, or some of them come off of the Bitcoin code that have a limited supply. And the attempt is to try to have that macro level, that store of value. We want to put our money there to be able to hold on to value because there's a limited supply. So that's a little bit about Bitcoin. Now, the brilliance of Bitcoin, that the fact that it has lasted all this time and this incentive structure became successful, spurred on even more development. And we realized, hey, we don't need all that centralization. We don't need the banks and all these companies in the middle to tell us what we can and can't do with our money. What else can we do with this idea of decentralization and these different incentive mechanisms? And that is where we got even more exciting, because we took this idea of decentralization and those incentives, and we came up with what we call DeFi, or decentralized finance. We looked at all these other aspects of finance and we said, where else can we take out intermediaries and pass on those fees and take away that friction, pass on those fees to those that are actually participating in this ecosystem or in this economy? We looked at parts of the economy, say lending, right? What is lending essentially? I put my money, or in this case, we'll call it my ETH, which is another cryptocurrency, into essentially a bank, correct? Or some sort of company, and that bank then lends that out and receives an interest rate in return. Now, ideally, I would get some sort of interest rate for lending my money or depositing my money in the bank. Of course, we all know you're not getting a whole lot of interest right now. So these people who built these decentralized systems said, what if we take this away from the bank and just make it code? Can we do that? Can we make an algorithm? Can we make code that we can deploy in a decentralized way to do the same function as a bank? And the answer is absolutely you can. And they did it. So we have almost a decentralized bank, a decentralized code or protocol that says I can deposit these digital assets, they're digital representations of money. I can deposit those and I can receive an interest rate. And this algorithm is constantly calculating and saying, all right, if someone else wants to borrow, here's the collateral that you have to put up, again, in a digital format, and you pay us back an interest rate. And if you default, we're going to take your digital collateral and we're going to pass it back on to these people who contributed capital. Just like in the case of Bitcoin mining, you contribute your capital in the form of your time, your money, your processing power, your electricity. In this case, you might contribute your capital in the form of digital assets. You put into some sort of protocol and expect interest in return. Now, what other parts of the financial system do we see this in? What about exchanges? Okay, exchanges are a place where we see a lot of fees and friction. You see a lot of market makers and such. Well, what if I can contribute my capital? What if I can contribute assets that I own to some sort of protocol or pool that then allows others to exchange them? Well, that's really novel, because we don't necessarily need these centralized exchanges in the middle. We can make this decentralized. We can make it to where the code, the algorithm will take care of it. It will know how much is going in, how much is being traded. It will charge some fee here, and this fee will get distributed to me, someone who might have contributed capital, and it will get distributed to someone who owns what's called a token. And this is essentially someone who can help govern or help control or help with the governance of this particular protocol. And some of this fee for the trading goes to me, who provided the capital, and some goes to these token holders who are helping to govern. So on the Bitcoin level, people like Jeremy and Jeff are looking at the macro factors. And on the micro level, the tokens like this that exist in the decentralized finance ecosystem, people like Jeff and Jeremy are really good at looking at the microeconomics. This exchange, which is a protocol, this bank or this lending protocol that's out there, how much of a market is there going to be? How much are these fees going to add up and accrue value to these tokens? So Jeff is very good, as he'll tell you, as he'll explain later, at looking at these tokens, looking at these protocols and identifying what is the market going forward, and therefore we can extrapolate, here's how much these should earn in fees and therefore accrue to these tokens. And as a fund, we're going to look at the value of these tokens. Jeremy is going to say, we're going to look at guys like Jeff and others who are allocating to Bitcoin and other cryptocurrencies and help you as an allocator, as a fund, decide how are we going to allocate our money among Bitcoin, the macro, and DeFi, other digital assets, the micro. So I hope that helps just a little bit. 10 minutes doesn't quite do it justice, but I wanted to help give a little idea of how these incentive structures are driving what is essentially the value creation, either the macro value creation or the micro value creation of digital assets. Jeremy Boynton with Pure Crypto, over to you.
Thank you, Adam. And thank you, Bob and Jeff, for having me on this panel discussion. I'm excited to be here. I wanted to perhaps start my 10-minute discussion or thoughts with maybe just a journey that I have gone on in the cryptocurrency world myself, because as Bob mentioned earlier, I do own a registered investment advisory firm. That's my primary business. And this Pure Crypto hedge fund of funds is really an outcropping of that business itself. So in the spring of 2017, I decided to take a pretty strong look at Bitcoin. I had no idea what it was, but I kept hearing about it. And it was just sort of a research experiment that I wanted to get on to just to be able to understand what it was intellectually first. And as I got further into that process, over the course of a maybe 2 or 3 month period, I started to realize some of the disruptiveness that blockchain technology and digital assets might have on the economy. And really, I say that it was really an aha moment. I was coming out of college in the internet, when the internet came into being in the early 90s, and I was a skeptic. I was a naysayer. I didn't really believe it was going to go anywhere, which is embarrassingly laughable now. And when you get to the late 90s and you realize, oh, it's a big deal, there's sort of a sinking feeling where you realize this is once in a generation opportunity. I probably missed it, and it probably is never going to come around again. When in fact, as I started to understand the disruptiveness of blockchain technology and digital assets, it was exciting because I realized that it wasn't a once in a lifetime. It's at least a 2 in a lifetime. It's that kind of scale of disruption that we're talking about. And so I immediately started thinking about how to put together a hedge fund, pick coins, and just started kind of positioning my firm to do that. But at the time, the ecosystem was so small, the asset class was so nascent that really to find any way of adding measurable value, you had to have an NSA level understanding of cryptography, which I don't, and you had to know how to program open source code on a blockchain, which I have never done. If you couldn't do those two things in 2017, there was zero chance you had an ability to actually evaluate a cryptocurrency or blockchain technology idea and hope to be anything more than just throwing darts. And so kind of went through a little bit of a deflation when you realize that, and then kind of reinvented the idea of using the old school hedge fund of funds, which in my opinion is really a dying animal. There is no more reason to use hedge fund of funds for the most part in investing. There's no access restriction issues. There's not really even a minimum investment issues. Most hedge funds, non-crypto, you can go direct to them and create a portfolio with fairly small amounts of dollars. That is not true in crypto. The access is really restricted. It's hard to get into the best funds. To put it into perspective, there's only about a dozen funds in the country that manage $100 million or more. That is a really, really small, finite universe of managers with any substantial amount of sizable capital. And most of them have really high minimums. So we immediately set out, and this is sort of summer of 2017, to fly all over the country to meet all 12 of those managers and try to figure out which of the managers in that small pool of managers that we were able to find were actually worth investing in. And today we've got a 3-year track record. We launched the fund January 1st, 2018. We got 5 managers in the fund. By most accounts, the industry kind of sees maybe there's 7 that are considered cream of the crop, top managers in the space. And we've got investments in 5, and we chose not to invest in the other 2 because they were redundant to a couple of the managers that we already had. I know it's probably interesting to you guys to hear how we think about choosing those managers. And, I wish I could give you almost like a fancy Morningstar style box analysis, dissection of the intricacies of the different strategies and ways to manage money in crypto. But I think I'm going to disappoint you by saying that's not really here yet. The asset class isn't mature enough to do that. I'd like to tell you a quick story about how the venture capital world in blockchain technology has morphed over a 3-year period of time. So in late 2017, early 2018, when we were deciding to launch the fund, we had a question. We had to decide, were we only going to take allocations of hedge funds trading in liquid tokens post ICO, which is akin to an IPO, initial coin offering, or were we going to also allocate to venture capital managers who were doing early seed stage rounds pre-ICO? And at that time, we chose to not invest in the venture capital world because the gap in time from a venture capital project to the initial coin offering was literally between 3 weeks and 3 months, like literally 3 weeks to 90 days. A white paper would be created. They'd circle up investors, and they'd launch a token before they built any technology. It was like the go-go days of the internet, where hundreds of ideas were coming out a day and getting funded with little more than a PowerPoint marketing deck. And because of that, we didn't really see there being value creation in the venture capital world. We felt like the tokens were coming to market so fast, we would be able to accrue most of the value in our hedge fund product without having to deal with venture capital illiquidity issues. That has massively changed over the last 3 years. Today, it's much more akin to traditional venture capital, and you've got a 3-year multi-early stage private round model before they get to their initial coin offering. And so you do have a substantial amount of value accrual occurring pre-ICO, if that makes sense. And I tell you that story simply to say the industry, that whole change took less than 3 years to happen. It actually happened in more like a year and a half at the most. And so managers in this space, by definition of the size and the space itself, have to be very nimble. You cannot put really strong boxes on how you allow the managers to morph with the industry, because we don't even know exactly how it's going to morph. What you really need to do is find the smartest guys in the room and realize there absolutely is alpha. There's a small herd of talent that will attract the most interesting projects and have the capacity to provide capital allocations to the best ideas. And so now there are some things, there are some boundaries that we put on them. And with that kind of as a backdrop, I kind of want to get real quickly into sort of some of those boundaries that we look for. There are really kind of 3 worldviews that we're looking for that are different. You know, we have one of our managers by the name of Block Tower Capital out of New York is really a trader mindset, right? These guys come from Goldman Sachs. They think about the world in terms of a trade. They definitely don't want to be in and out. They definitely want to be long the beta of the space, but their preference, their comfort zone is to think about the world as a trader, and they're good at it. Then we have kind of the tech guys, the next killer app, the guys that are really focusing on the science and the tech, and want to serve really big world problems. And there's a section of managers that really are next big idea. What's the next twist, like that Adam's talking about in DeFi. And there's a pool of markets there to go look at managers to allocate capital to. And the third one is the most recent addition. And I would say that in my opinion, Arca is probably the only really credible manager that I'm aware of that is in this space, but it's a value space. It's truly a Warren Buffett, Graham and Dodd look at evaluating tokens. You can't do that to Bitcoin. Bitcoin is seeking to be digital gold or some form of money. Money is worth what money's worth because we say it is, and because everybody believes that. There's no cash flow, there's no yield, there's no price to earnings ratio, but there's a small yet rapidly growing corner of digital assets where it absolutely is attached to real world balance sheets with real world cash flows, with real world profits. And those assets are trading in a crazy landscape where there's massive price misallocation. People just don't understand what's attached to the token. And that has created space for guys like Jeff and his team to come into digital assets and really provide significant major alpha. So those are the three different worldviews that we look for in trying to create a team of managers to put together in our fund of funds. I think maybe two more questions or two more thoughts. I'm just looking at my time to make sure I'm not too far over. I want to talk about one story to kind of reemphasize something about this venture capital stuff. So we have an allocation to a project called The Graph. You can actually look this up on CoinMarket or any one of Coinbase, any one of those crypto website for price action. The symbol is GRT. So the Graph is basically it's like a data query tool. So it actually virtually every DeFi token out there uses this token, uses this tool to go query data to figure out how to match the lenders and the borrowers and things like that. So it's a database query tool protocol engine coding thing that came to market a few weeks ago, maybe a month ago now. And the initial price, here's kind of the punchline I'm trying to get to. The initial price, the first price in the public post-ICO market was 13.8 cents per token. We invested in that token through one of our managers at 0.1 cents, so a tenth of a cent. So and by the way, the first trade in the post-ICO market was the lowest. It hasn't been back there since, and it's double that, triple that now, somewhere around there. But that 0.1 cents to 13.8 cents is 138x value accrual that now resides in the venture capital world. That we want allocations to those projects. And so as that happening started to become routine, and we started to realize that there was value accrual in the privates, we've adapted and adopted. And so we definitely have a significant exposure now on the venture capital private side. But I thought that might be interesting and helpful to you in thinking through how these allocations can migrate and change. It's nowhere near what it is in traditional stable public markets where you've got pretty pie charts where the asset classes aren't morphing every day. And then the last point I kind of want to make, I want to talk about the MySpace to Facebook analogy. And it's probably overused. You guys have probably heard it a billion times. But MySpace dominated social media for 5 years, between 4 or 5 years, between 05 and 08, before Facebook overtook them. We're adding 100 million users a month during that stretch of time. And I'm not using this analogy to say that Bitcoin's going to go away and there's going to be a Bitcoin killer. I'm actually kind of coming in the back door and going to make another analogy. When the internet was created, and when it really started to become popularized, and when people started to really think, hey, is this thing for real? That was like about 1993, 1994. At that time, nobody had a clue that there would even be something such as social media. So my point isn't almost as much to compare the MySpace to Facebook analogy and figure out if there's a Bitcoin killer out there. That's not it at all. It's to say that if you jump forward, what is that, 05, you're talking at least 12 to 15 years from the onset of new technology, there is a second derivative idea that was not contemplated with the birth of the initial technology. And that's what we don't know. We have no idea how far-reaching the implications and the impact of this technology is going to be as the digital assets universe expands over time. And I think at this point, Jeff, I'll turn it over to you.
Great. Thank you, Jeremy. And thank you, Adam, as well. I think both those were really insightful. For those who don't know me, I'm Jeff Dorman. I'm the Chief Investment Officer at ARCA. Amongst other products, ARCA has a digital assets hedge fund that's really more of a special situations fund. Like as Jeremy was alluding to, when we talk to investors for the first time, and obviously everyone listening right now probably is coming in at a different level of education or a different level of sophistication with regard to this market. But it's funny because cryptocurrency, the word, and Bitcoin is now so ubiquitous. it's pretty obvious that everybody who comes into this space starts there, right? That's the hook that gets people into digital assets. But in some ways, it's almost like when you meet someone with a really bad golf swing. Sometimes you have to, fix that swing over and over again. And other times it's just easier to turn them around to the other side and start over. And a lot of times we find ourselves doing that with investors in this space because there's so much misinformation out there and so many generalities that are just no longer true that we really do have to kind of think of this as a fresh mindset. As a starting point, when we do turn, investors from one side of to the other, the first thing we think about is like, let's look at the entire asset class. This asset class really is much more akin to fixed income than to equities or commodities or currencies. And the reason we say that is there's no such thing as as a fixed income investor, right? There's pockets of fixed income investing, right? First, you've got the different types, right? You've got govies, you've got munis, you've got corporates. Then you have the different maturities and coupons, right? There's an infinite numbers of combinations of coupons and maturities that you can put on a bond. There's different structures, right? You've got callables, puttables, convertibles, preferreds, warrants, you name it. Not to mention all the covenants in there. That's really where we see this space right now. Every token is unique and different, and there's just not one size fits all. There's not one analysis. There's not one type. You can put a sinking or velocity type feature on a token. You can have an amortization schedule. You can have an inflation schedule. You can have buybacks and burns. There's all these different ways that you can accrue value to a token. And what that ultimately means is that cryptocurrency or Bitcoin, while significant and important and a great investment that everyone should probably own, it's just not even close to what this asset class really is now. So when we look at investing, we first want to break down the universe of what it is that we're actually investing in. So to keep it simple, we break down this enormous asset class into 4 categories. The first being Bitcoin and cryptocurrency, which really is very difficult to value, right? It doesn't mean it won't go higher. It doesn't mean it's a great investment, but it's hard to value. There's no one, we already heard Adam speaking about this. There's not a great way to value what one Bitcoin should be worth in dollar terms. What we know is that Bitcoin relative to purchasing power or relative to gold might have some relative value. There's only a few other cryptocurrencies besides Bitcoin, and most of them, in our opinion, is just not very investable. So we don't spend a lot of time thinking or investing with Bitcoin or other cryptocurrencies. With the next level of in this asset class is what we call the protocols and platforms, right? These are the base level building blocks of blockchain, right? If you think about what SMTP, the base layer for email, or HTTP, the base layer for the internet, that's what these protocols and platforms are doing in blockchain. You've got Ethereum, you've got a couple that you may or may not have heard of, like Tezos and EOS and Cardano, but really, again, very difficult to value. These are very popular investments for the venture capital community because they have enormous upside, right? If you could buy the internet in the early stages, you would obviously do that, right? If it works, you're going to have the entire world built on top of it. But it's very hard to say what that is worth today, other than if you buy enough of them and spread your bets around, you might get 1 or 2 of them right. Again, not a lot. We don't focus a lot there because, again, it's hard to value. What we do as special situation and value investors is we focus on the other 2 types of tokens. One is asset-backed tokens, and that should sound that should sound exactly like what it is, right? This is a token that is backed by some form of a hard asset. That asset can be equity, it can be debt, it can be a hard physical asset like land. It can be backed by an income stream, right? We've actually seen an NBA player tokenize his income, his actual NBA contract. So asset-backed tokens obviously can be valued in the same way that a bond or a stock can be. You can use cash flow analysis, you can use DCF, you can come up with some sort of a real value for what the price of the token is. And this is a growing part of the market. And when you find these opportunities, not only do they have immediate value, but at the same time, because this industry really doesn't have a lot of value investors yet, you get dislocations all the time. We recently bought the token of an insurance mutual where we were buying the token at a 30% discount to its book value. And this insurance company is focused in decentralized finance. So effectively what we were doing is we were getting paid to buy a call option on the growth of decentralized finance. That shouldn't exist in a growth industry, right? Price to book should be 5 to 10 times in a growth industry, certainly not at a discount. But these are the types of investments that we can find in a space where you largely just have traders and venture capitalists and not these deep dive value fundamental type investors. So we found a lot of opportunities in the asset-backed space. The fourth type of asset that we look at is what we call pass-through tokens. And a pass-through token is the most interesting, the most unique, the most different types of value drivers. And really, these are quasi-equity investments, right? These are the tokens of early stage companies or early stage projects where you as a token holder have some sort of value being passed through to you. That value could be in the form of rewards. It could be direct revenue or profit pass-throughs. It can be in the form of dividends or buybacks, but there's some form of a pass-through that is coming back to you as a token holder. And why this is so interesting is because we're in a period of time right now where the wealth inequality has never been worse, right? And there's really no way to solve it by the Federal Reserve or through monetary policy or even fiscal policy, right? All you're doing is increasing the assets that a very select few own and inflating the purchasing power of everybody else. There's almost an ESG component to investing in pass-through tokens. You're almost doing a public good, because what you're effectively doing is you are democratizing the wealth effect or the growth of these early stage projects. Instead of a couple of early stage investors who get all of the profits when a company goes public, now you have an environment where these pass-through tokens are being issued to not only the founders and the early equity investors, but the developers who are building on the project, the customers who are the first ones to use and bootstrap the growth of a project. You're now incentivizing growth through this token. And it really is not only valuable and something that you want to own from an investment, but it also leads to a fastest appreciation of a company or a project than we've ever seen. This is why there's more unicorns, billion-dollar valuations in the digital asset space than anywhere else. And they've become fastest to unicorn status, is because when you're incentivizing your customers through financial profits at the same time as you're providing them a utility for using your product, you basically create evangelists overnight. An analogy we like to use is, imagine Amazon. Imagine if there was, right now you have Amazon shareholders, and Amazon shareholders make all of the money when Amazon succeeds. But then you have Amazon Prime members, and Amazon Prime members get most of the benefit of Amazon's product, right? And more importantly, Amazon Prime members have gotten a lot of new benefits over time, right? You first thought you were just getting free shipping, but now you get free shipping, Whole Foods discounts, movies, music, right? They've added to the utility of the Prime member. But what I pay for an Amazon Prime membership is the same thing that you pay, and there's no difference between being first or last, right? They didn't do anything to incentivize growth through the Amazon Prime membership. What these pass-through tokens are doing is they're saying, if you're an early buyer of our Amazon Prime membership, we're not only going to increase the utility of your membership over time, but you're basically going to be a quasi-equity holder, and you're going to grow with us as we grow. So again, you're democratizing the wealth effects, and you're also incentivizing growth at the same time. And I think this is really important, not just from an investment standpoint, but it's really important for society. Look no further than DoorDash and Airbnb. Did I lose you guys? It looks like I'm still there. Okay. Look no further than DoorDash and Airbnb. Recently both companies IPO'd and created hundreds of billions of dollars of wealth for their early stage equity investors. But who didn't benefit? In Airbnb's cases, you didn't have the homeowners benefit, and you didn't have the people who like to take vacations benefit. In the DoorDash case, who didn't benefit? The people who cook food, the people who eat food, the people who ride bikes and deliver food, right? This is where we're headed. Is not only are these incredibly valuable instruments where you can get in and invest in them and decipher what the cash flows are and why there's value to them, but you're also going to introduce an entirely new set of investors into the capital markets. And I think we can all agree that there is some benefit to that. So that's the way we look at the world. We are looking for these value opportunities. We're looking for companies and projects that we can back, but it's not what you might have thought. It's not money. It's not cryptocurrency. We're not, the first investor in hoping that 1 out of 20 projects is going to work. These are projects and companies that have, been around for a year or two, and then introduce a token later and work tirelessly to figure out how to accrue value to that token through the cash flows or the revenues or the other things that they're doing. So if I can leave you guys with anything, it would be simply clear your mind of what you know. Bitcoin is great. Bitcoin's important. And I'm glad that all of us are here today. But now think more about what else is there and how there are teams like ourselves at ARCA and like, other funds that Jeremy and his team are investing in, who are really taking advantage of the real growth of this asset class, which in my opinion is much farther reaching than just money or cryptocurrency.
Okay, I think that's my cue. I'll kind of start the Q&A session for everyone listening. My name is Zach Lindquist, and I am with Pure Crypto. And I'm going to change the view here so we can see all the panelists. Here we go. Okay, let's start with a few questions. Jeff, I actually want to come back to you on this idea of pass-through tokens. I think that's something that deserves maybe diving in a little deeper. I'm just curious, do you have a timeline on when you expect to start seeing these token structures take place? And really, what are the hurdles that are kind of stopping firms from doing that today, if there are any?
Yeah, that's a great question. So let's start with an example, because I think that might help. There's an exchange called Binance over in Asia, and Binance was one of the pioneers. They introduced the BNB token. But Binance also has equity, right? Binance was funded through equity investors. You can have a token and have equity. One doesn't replace the other. But what Binance did is they issued this BNB token and said, if you own a BNB token, when you use our platform, and their platform is an exchange used to buy and sell different digital assets, if you use the BNB token, you get discounts and other perks for using the BNB token on our platform. But also, if you own the BNB token, we're going to reward you economically by passing through 20% of our profits directly to BNB token holders, right? That's that hybrid relationship between utility and quasi-equity. So that's an example of how it can be used. Now, what's stopping this from being used? Well, first of all, think about what kind of a company Binance was. Binance is a company dedicated to the trading of digital assets. So by definition, anybody using their product was also familiar with a token. So the Venn diagram of people who understand their product and people who understand digital assets is just one circle. If you tried to introduce a token to, say, Starbucks, even though it makes all the sense in the world, right? Starbucks could do the same thing where they have a token and that token gives you rewards and other discounts, but you also have a quasi-equity stake through pass-through of revenue. The problem is 99% of the people who shop at Starbucks probably have no idea what a blockchain wallet is. They could use a lesson from Adam in terms of how this works, and they wouldn't be able to function using a token. So I think that's the biggest disconnect right now, is the difference between the customer base and the willingness or education of what a blockchain token is. The second one is regulatory, right? It's easy for an Asian company like Binance to pull this off. How does a US company do this right now? It's not that the laws say you can't do it, it's that there are no laws, right? There's no precedent, there's no ability to do this in a legal way because there is no legal precedent. So we talk to capital markets bankers all the time, and they want to get involved here, but they don't even know how to. So I think it's going to take some time, but it probably is going to be, some company that's big enough to do it and push the envelope and force them to regulate it, and then others will follow suit.
Yeah, absolutely. And actually, I want to direct this next question towards you, Jeremy. Just putting your RIA hat on for a second. Given the extreme volatility we're seeing in the crypto markets, how do you think about sizing allocations in client portfolios?
Yeah, so I would say that up until, probably late last year, fourth quarter of 2020, virtually all of our clients inside my RIA are exposed to digital assets through our fund, Pure Crypto. And the allocation conversations that we were having, beginning in 2018, up through about fourth quarter last year, were, look, this is really risky. Probably the most risky thing that I've ever recommended to my clients ever in my entire career. And you really need to be able, whatever check you write, you need to be able to live with it if it goes to zero. I mean, the risk reward is, it's very, very different than trying to make a double on a real estate deal or something like that. You need to have 10, 20, 30x potential, not guaranteed, but potential to have the incentive to allocate. And consequently, it's a tail of your portfolio. And so we were saying 2 to 3% of your allocation, 2 to 3% of your portfolio total. If you lose it, it's not fun, it sucks, but it doesn't change your life, and it actually doesn't significantly change your portfolio value at 2 to 3%. But if we're right and we get 10x, it actually becomes a very meaningful allocation to your overall portfolio. So that's kind of how we have been framing it. I'm going to say that as Adam was talking about earlier, all of these institutional players that are now beginning to come to the fore and start allocating, it's really caused us to rethink that and double, like to a 5 or 6% allocation. It used to be when we first started allocating, you were taking career risk to make an allocation to crypto. Today, it's the flip. You're actually taking career risk on a go-forward basis if you don't have an allocation to crypto. So we think there's been enough of a jump in the maturation process of the asset class overall to double our initial 2 to 3% allocations.
Okay, and then this one's kind of just open to any of the panelists, but just considering the risks in this space, either Jeremy or any of you can answer. What do you consider the greatest risks in the market today, and how should investors be managing that risk, or maybe how do you manage that risk?
Let me, if I could jump in for a second. One of the biggest risks we see is of investors that try to do too much of it themselves, try to just say, look, I don't need to pay a fund and I'm just going to go maybe buy Bitcoin. And I know that everyone on this panel has seen the horror stories floating around about people who have one password left to get their $220 million worth of Bitcoin out of a wallet. So a lot of it is honestly, there's a lot of tech risk here. And the tech risk is if you are trying to do all this on your own and you're not savvy and you're not versed in the technology, there's definitely some risk there. We talk a lot, or we hear a lot about regulatory risk, and there's not as much of regulatory risk around Bitcoin. There's probably more around some of these other tokens just by virtue of the fact that some of them actually could be deemed securities, and the SEC or whomever could possibly come down with some sort of suit or some sort of complaint against them. There is some risk there, and of course there, as Jeff alluded to, these are essentially companies. So you're hoping that their management is good, and you're hoping that they are able to do and get the market share that they think and that you think they can get. So this is a very nascent industry trying to break into what is a traditional finance industry with traditional players that have been there a long time that don't really want these decentralized players in there. So there's quite a bit of hurdles to get over, not just in the regulatory aspect, but in the aspect of there are a lot of players in there that aren't very welcoming to new technology, that don't want all this new money coming in and don't want their centralization. They don't want to be taken out of the picture, and they're going to fight tooth and nail to keep everyone out.
Jeremy, Jeff?
Yeah, I think I'll just try to keep this short, but I agree with Adam. I do think the regulatory issue is a big one. I actually think there's a silver lining on that one, though, because once the regulatory cloud gets solved, the onslaught of institutional capital that's waiting for that will become even bigger. But I also think, maybe the elephant in the room is just volatility. I mean, since 2009, Bitcoin has crashed 75 to 80% 4 times in its short life. And everybody knows that. It sounds good on paper until you live it. And people that think they could stomach that because they're actually seeing the 80% crash and then the 20x afterwards, it's hard to do that if you can't see that up into the right part of the chart, and most people make the wrong decision at the worst time.
Jeff, any comments?
No, I mean, the only thing I would say is this is incredibly difficult. I mean, this is, it may look easy when you see something that goes up 40x like a Bitcoin or Ethereum, but the path there is very difficult, and the amount of research and time and energy we spend. I mean, I've invested in every asset class, every region, every sector. I've never spent more time or energy learning this space. And that's not to discourage people from doing it. I think everybody should learn this space. And obviously, if you're on this call, you're already doing that. But this is hard. I mean, I have a 7-person team working basically around the clock 24/7 to uncover the ideas that we're talking about. So to expect to do this on your own is pretty difficult right now. And the passive options are really terrible right now. I would never disparage another fund or another company, but the passive indices that have been built in the space that are meant to diversify you, they're built on antiquated rules that don't fit this space. Market cap is not something that really matters, truthfully, and more importantly, to design an index or a rules-based index around, in such an early stage while we're still evolving, would be like the equivalent of creating a tech index and not including Apple, Netflix, and social media. You just can't do it. So I think I encourage everybody to experiment and learn, but I also think there's a reason that active managers exist in this space, as Jeremy alluded to earlier. This is definitely a professional sandbox right now, and probably more appropriate for retail over time.
Yeah, I couldn't agree more. We're not talking about maybe 1 or 2 of the top 10 coins being posers. There are a lot of coins in the top 10 coins that when you talk to the smartest guys in the room, it's crap. It is absolutely untenable on a go-forward basis. And it's a lot like the bubble in 2000. There were massive valuations for company that shouldn't have been in business. And I think that's what happens in early stage technology plays. It's so much like the internet bubble that I think there's going to be a lot of weeping and wailing and gnashing of teeth at some point. Don't know when that stuff happens, but there's a lot of pretenders in the mix.
Well, look, we're getting up on 2 o'clock here, guys. So I know, again, I want to respect everybody's time. So I thank you very much, panel. Thank you, Zach, for the Q&A. Thank you, Adam. Excellent job, Jeff, Jeremy. And, most importantly, thank you all to the guests. We'll follow up with some emails with our contact information. And like I said, earlier, and I can reiterate that, this is a rapidly growing asset class. And at the end of the day, clients are going to want more exposure to the asset class. And we are just two ways to find that exposure. So again, thank you very much, and have a good day.